Chapter 2, Job Order Costing. This is a continuation of Chapter 1 and builds on the concepts of Chapter 1. So hopefully you will find a lot of links and it will make the chapter a little bit easier to understand. When we're determining product unit cost, as we learned in Chapter 1, it's extremely important information for us to gather. Let's do a quick review first. We have in a product cost materials, labor, and overhead. Overhead is typically estimated because we don't know exactly how much overhead is going to be until the end of the year, and we need to apply overhead uniformly throughout the year because, for example, we don't know what the property tax bill will be until the end of the year, and yet that is overhead. Property tax on the manufacturing facility where the product is made is considered overhead because it's a product cost. So managers have to develop this product cost information for this list of 6 items here: budgets, determining price, sales goals, hiring, ordering, efficiency as far as their rate goes. As a quick example, it's well known that if Boeing gets new orders for aircraft, or if they lose orders for aircraft, they either go through a huge hiring process or they start laying their employees off. And that's just one of the things that has to be done in a manufacturing organization. So there are 2 product costing systems. They're job order costing or process costing. It's not a choice. It's determined by the type of the product. So this is a list. Chapter 3 is process costing. We will be covering Chapter 2, job order costing, in this narrated PowerPoint system. So job order costing is a bit more basic. It's something that I always think of whenever I think of building a custom home. There is a specific job order. It has a conclusion. It has one work in process inventory account. There is only one inventory account for the finished goods, and typically it's a unique or specialized order. So again, that fits very well with a contractor building one home. The start to finish has materials, labor, and overhead accumulated in a job order costing system, maybe on a job order cost sheet, and when the house is built, it's done and they have a finished product. Could also work maybe if the contractor had 3 homes that were supposed to be very similar and they were built side by side. That happened recently in a neighborhood where 3 homes are very similar side by side. One contractor built the 3 homes, so he would add up his materials, labor, and overhead and divide by 3, and he could figure out the cost for one custom home. Now let's go to what we'll be discussing in Chapter 3, which is process costing. And that's this one here. It traces production costs to processes because there really isn't a beginning or an end, and that makes it a little bit tricky. Process costing has processes such as a cookie manufacturer. Let's say that they make Oreos. There's a mixing, maybe a baking, a packaging, and this process never really stops. It's a continual process. There's no end. They may halt production for a little bit, but there's always partially finished goods. So process costing is a little more tricky to do. They usually look at a specific period of time, like how many Oreo cookies were made during this week. There are several WIP accounts, work in process accounts, and they use an inventory account for each of these WIP accounts. And it's typically done a process that's used by companies that have very similar products. Toilet paper, candy, bricks, drinks. I went to the Budweiser manufacturing facility in St. Louis once, and they are continually manufacturing beer, whether it's bottles or cans. I mean, there's obviously a time when they stop the packaging process, but in the brewery component, the beer is continually being brewed. There's an area where it's very hot, there's an area that's very cold, there's areas of fermentation, depending on which beer that they're manufacturing. But that is a process costing system. Job order costing systems generally go. Okay, so as you look at these, see if you can think for a minute. This is a custom home. Looks like they're processing a candy. It's sort of like the old school I Love Lucy video, if you remember that. And if you really want some side information, Google I Love Lucy and look for candy manufacturing. It's a very old 1950s or 60s video that I like to show in class that shows them manufacturing candy, where the manufacturing line just really never stops. Similar to this, similar to this. So this looks like job order. This looks like maybe job order. This is process, process, process costing. Job order costing is going through the three materials, WIP, and finished goods inventory accounts, the big three, as we talked about from the last chapter. And we're going to go through some transaction analysis in the next several slides. So these are the T accounts. And notice that we're going to have some automated transactions. So let's look again. We have materials, WIP, finished goods. These are our three inventories. They are assets. Wages payable will feed into WIP. Overhead will feed into WIP. Cost of goods sold goes on the income statement. It is a product cost after it has been sold. Remember, this is an expense account. So transaction number one, there are materials that have been purchased and they're sitting in inventory. You can picture this as a warehouse. And when the materials are requisitioned onto the manufacturing floor, picture this, the manufacturing facility for this product. Then direct materials go out of the materials warehouse through a credit, if you're looking at T accounts, and they are debited to increase the inventory account work in process. Okay, indirect materials. Notice that indirect materials are those that's not convenient or economical to trace. So yes, they're materials and they're stored in the materials warehouse, but they go to the factory overhead accounts so that we can apply them using a predetermined overhead rate later. Direct labor. Direct labor comes from wages payable. It's labor that it's easy to figure out exactly how much labor is being done in the manufacturing process, so it comes straight from wages payable. Next, we have indirect labor. Indirect labor is also wages payable, but it's not easy or convenient to trace it to the product. So you can think of the engineers. They are part of indirect labor. They may be called into the job. Yes, we have to pay wages to our engineering staff, but they don't work on one specific product, and they don't work continuously, and you can't directly trace their costs. So we apply their costs through a predetermined overhead rate. Other manufacturing overhead comes through, and other manufacturing overhead is going to be everything from the electric bill, property taxes, insurance, rent or depreciation on the building and equipment, items like that, and you'll see others in your textbook. Next, we're going to apply, based on a predetermined overhead rate, our factory overhead, and it's called an allocation actually. So factory overhead is allocated through this predetermined overhead rate. We haven't talked about it extensively other than the definition, so stay tuned in this chapter 2 while we get to that stage and we can help you a little bit with understanding. Cost of goods manufactured. Once you've accumulated materials, labor, and overhead, which has been applied, then once the product is finished, it goes into cost of goods manufactured. And I want to take a pause here for a minute. I want you to look at this. Inventory, inventory, inventory. Nothing's been sold yet. Materials go into WIP, or if they're indirect and you can't really trace them, they go into overhead. We have materials, labor, and overhead. And once the product is finished, it's transferred into finished goods. And that's the process. You'll see that also demonstrated in Chapter 2 of your textbook. Next, we show that once the product is purchased by a customer, it is sold. Notice how it's transferred from the finished goods T account to cost of goods sold. For a very quick reminder, cost of goods sold is an expense. It's increased by a debit. The inventory accounts of materials, WIP, and finished goods are all assets. They're increased by a debit. So what we've got here is a story of the fact that these are the goods that were manufactured. They're sitting in a finished goods warehouse. Once they're sold, they're transferred out and they go to cost of goods sold on the income statement. So let's look at a quick example with a golf cart company. Here's their materials, labor, and overhead. These are all direct materials costs. These are the wages of 2 employees. All of these are overhead costs, and you should right now be saying, okay, I have to apply these overhead costs to my job using a predetermined overhead rate, because that's what we're going to be studying. Look through this list carefully. Okay, they build customized and general purpose golf carts, and we have materials, WIP, and finished goods, just like we've studied already. So let's take a look. Here are our T accounts set up. Materials, inventory, and inventory, sorry, the PowerPoint's not showing that on this one, but this is materials, work in process inventory, and finished goods. And down here are something called subsidiary ledgers. So that's your general ledger. These are subsidiary ledgers, and it's a new concept we want to throw in there if you're taking notes on new terms. A subsidiary ledger is a backup or support. We have $1,230 worth of materials. These are the specific categories of materials. We have $400 in work in process, and these are the ongoing jobs. Looks like it's all job CC, and there is no finished goods inventory. Okay, so follow the T accounts, the bright red, and you will see that in the materials area, we made a purchase of cart frames and wheels. This is the primary account, the general ledger account. These are subsidiary accounts, and this is the information. Next, we buy some more materials. These are indirect, and so they go down here into the indirect materials account. The production requests, it's called a purchase requisition, frames and wheels. So we show the frames and the wheels coming out of materials and going into, again, this is work in process, and we reduce our subsidiary accounts so they always equal our general ledger account. We also allocate them to the jobs. So those materials went to job CC and JB. Payroll hits us. There's $96 in, excuse me, I'm sorry. Payroll just popped up there. Indirect materials are also requisitioned on the job, but these materials don't go here. We show the indirect materials were used down here. And we show that those indirect materials are going to be plugged into our overhead account to be allocated later. Now we go to wages. Factory payroll of $2,400 comes through. It's a clearing account. It only holds costs until they're ready to go. And we will show that in factory payroll, $1,640 is direct, and $760 worth of payroll goes into our overhead accounts. This again will be allocated. We also show these in the subsidiary accounts. Notice that we have taken that $1,640, split it into job CC and job JB. The overhead account of $295 is also increased because those are indirect costs that were incurred through the overhead. Factory depreciation occurs of $240. That's added to overhead. We're going to allocate that later. And so now our overhead totals $1,394, and it's time to apply a POR. So they tell us that our predetermined overhead rate is 85% of direct labor. By the way, this problem comes out of the textbook. You can go into Chapter 2 and see how it goes. But the predetermined overhead rate is direct labor. So that means that for every dollar of direct labor that we apply to the job, 85 cents worth of overhead is applied. So here is our direct labor of $16.40, and we're going to apply overhead $13.20 here and $3.20 there, and that's coming from, as we go through our next slide, $13.94. So, sorry, $13.94 here, $11.22, and $2.72. So that's where our overhead is being applied. Once a job is finished, and we're going to see that job CC is finished, it's going to go to the finished goods inventory, which is this one, $38.80, and the finished goods subsidiary ledger has $38.80. That job's done, finished. Going to finished goods, we'll just wait on it to be sold. One golf cart is sold for $19.40. And we reduce our subsidiary ledger. We transferred into cost of goods sold. Now, when we prepare financial statements, what we're going to look at is that we've got some materials. Our overhead was cleared out. Sorry, our payroll is cleared out. Our overhead has a little bit of a balance in there. The materials are all calculated in their subsidiary ledger. We've got some of job JB left here that will match in our work in process. And we have one finished golf cart remaining in finished goods. So whenever we add up our overhead, we'll see that we allocated too much, just $3, and we're going to take that $3 and throw that into cost of goods sold. So it's actually going to reduce our cost of goods sold. And that's actually quite a good thing, because it means that it cost us $3 less than we thought it did to manufacture that one golf cart. Since it's a small amount, we just offset cost of goods sold. So end of period balances are all determined, and they're now going to be carried over into the next accounting period. So what we've got here is that we've got materials and we've got subsidiary ledgers that add them up. We have work in process for job JB, and we have one golf cart in finished goods, and our cost of goods sold is ready for the income statement. So here again is a summary. Materials, overhead, which has been zeroed out, our work in process, which is showing that we have $14.94 for job CC, I think it is, finished goods, cost of goods sold, and this is the way the T accounts transpire in a job order costing system. As a reminder, the overhead is estimated, and they use direct labor as a cost driver. So hopefully you've read Chapter 2, and you know what a cost driver is, and you understand what normal costing is, which is in Chapter 1, and that is when we estimate overhead and use a predetermined overhead rate. So in the next slide, we're going to look at a manufacturer's job order cost card. And this is what they look like. This is electronic. Most of them are electronic, but there's still a lot of contractors out there, a lot of businesses that do handwritten cost cards. Some of you may have worked in the construction industry, and you may have been required to keep up with your hours worked on a job, and it was on a piece of paper, and you worked 3 hours on this residential home and 7 hours on this residential home, and your contractor keeps track of that. That's what's happening here. Okay, product unit costs again is adding up materials, labor, and overhead and dividing it by the number of goods. Overhead is estimated. A lot of repeats. Hopefully this is helping you to understand the whole process. And so now let's talk about this predetermined overhead rate. We've mentioned it in several problems, but we've never really discussed how it works. So we estimate our overhead, And this is estimated overhead is called the cost pool. So as a reminder, just I think the more you're exposed to it, the better you are. Indirect costs are also known as overhead costs. These are costs that it's not economical and it's not convenient to trace to a product. Depends on the company. Some contractors in the construction industry know exactly how many nails go into the construction of their house that they're building. Other contractors don't care, don't pay any attention. And it is really a choice. Remember, managerial accounting is quite flexible. So let's get back to the calculation of a predetermined overhead rate. All the costs accumulated together are called the cost pool. Cost allocation is the way that the costs are assigned to a product in this overhead area. So the cost pool is assigned based on a cost driver. As the driver goes up, more overhead is applied. So you might be familiar with going to get your car repaired, and you find that they're going to charge you by the hour, and maybe it's $80 an hour, plus parts. And you know for a fact that the employees at that car service center don't make $80 an hour, because that's $160,000 a year, and there's not many mechanics that make that. So what they've done is they've buried their overhead into their direct labor costs. So for every dollar that they pay their employees, let's say their employees make $10 an hour, the employee gets 10 and overhead is 70, and they've buried it. So their cost driver is direct labor hours, and that's the way they apply their overhead. Okay, think again too, when they charge you for parts, that's considered direct materials. So we're going to create this predetermined overhead rate to apply our overhead. It can be a ratio, a number, a dollar amount. As we saw in the golf cart problem, the overhead rate was 85% of direct labor dollars. So for every dollar of overhead, they charged 85 cents. Now go back to the example of you going to a car service center. If they're charging you $80 and the service center is only paying their employees $10, then they're basing theirs on direct labor hours. For every dollar that their employees work on your car, they receive $70 in overhead, and that's their predetermined overhead rate. So here's the way it goes. Estimate your overhead costs, which is also called your cost pooled. Estimate your cost driver activity, and that is whatever management or the accounting system has determined makes the costs go up. And so you apply your overhead by taking, and this is an important formula, the POR up here and multiplying it times the actual cost driver activity. So if the car mechanic works 2 hours on your car and they charge $80 an hour, then $70 times 2, they've applied $140 worth of overhead to your job, and they've paid their direct labor $20, and then they'll also charge you for parts. Recording overhead, you're going to accumulate things that are indirect, such as indirect labor, depreciation, property taxes, all throughout the period, all of these debits. And then at the end, when it's time to apply the actual costs, you'll use the POR. It might be dead on, but it rarely is. It's normally off quite a bit. And then there is an over or under applied. In this case, it was over applied overhead. The traditional approach to allocating overhead uses one predetermined overhead rate. We will talk in a future chapter about how several overhead rates can be used with something called activity-based costing. In an activity-based costing, you can have many, many different overhead rates because different parts of production require different amounts of overhead as it goes through the process. Think about the manufacture of a multi-million-dollar jet at the Boeing airline industry. They would not have just one overhead rate. They would have overhead rates for numerous components of manufacturing, because the more precise the price they calculate, the better they are at determining how much it truly costs to manufacture one aircraft, and then they can figure out how much their profit is, how much they should charge, whether they need to pair costs. It's a very important part of manufacturing. Here's an example. The Ruiz Company lawnmower and snowmobile manufacturer. This is their overhead. So go back and remember the definition. It's not convenient or easy or economical to trace these costs. Engineering, quality control, setup of the equipment. They have $1.6 million in indirect costs that they have to allocate using a POR. They make snowmobiles and lawnmowers in one factory, and that overhead is for the entire year. And they plan to make 1,000 snowmobiles and 1,000 lawnmowers. And each requires 10 direct labor hours. So the question is this: how do I apply my overhead? And is that $1.6 million applied to the manufacturer of the snowmobile or the manufacturer of the lawnmower? And if we use one predetermined overhead rate, we'll do a simple calculation. And they have decided that they want to use labor hours. So the more labor hours the employees work, the larger the overhead. So if we've got 1,000 units manufactured with 2 products, that means that they've got 2,000 hours a year worked times the 10 hours of labor it takes to make each one. So there's 20,000 hours worked for this company. So we'll take this direct labor hours, which is our overhead rate activity driver, and we'll divide. So our estimated overhead, think back to the prior problem, 1.6 million, prior slide, and the estimated activity driver, 20,000 direct labor hours. So let's watch how it works out. From this, we can see that we have decided that for every hour of labor, we're going to charge $80 in overhead. Okay, the labor's easy to trace, materials are easy to trace, but our overhead of 1.6 million will be applied at $80 an hour. And that means that regardless of whether you manufacture a snowmobile or a lawnmower, $800 will be applied. So here we have it. We're going to look at how the $80 per direct labor hour is applied to the snowmobile and to the lawnmower. Because we use one factory-wide, as they call it, predetermined overhead rate, what we see here is that the snowmobile has $8 applied to its cost for the job, and the lawnmower has $800 per unit applied to its cost, because each one is $80 per direct labor hour, and it's $10 direct labor hours for each of these units. So the snowmobile and the lawnmower each have the exact same amount of overhead applied to them. And that's what happens when you use one predetermined overhead rate, and that's why it's called a plant-wide factory overhead. It's applied, again, based on direct labor hours. This is our POR. And whenever they go in to calculate how much it costs them to manufacture one snowmobile, they'll take this amount of overhead based on a POR. They'll add their labor, they'll add the materials to figure out how much it costs to make a snowmobile, and the same for a lawnmower. So let's do a quick bit of critical thinking. Do you think it costs the same as far as the overhead for these two products? Now we're going to answer that question in a future chapter with a future concept on activity-based costing. But for now, let's do a quick review of what we've done in this chapter. We've talked about how we apply the 3 inventories: materials inventory, work in process inventory, finished goods inventory. How jobs flow through materials, WIP, and finished goods, and when they're sold, they go to cost of goods sold on an income statement. We also talked about subsidiary ledgers and how they give specific details on the types of jobs we have or the types of materials we carry. Finally, we talked about how to apply overhead using a predetermined overhead rate by selecting a cost driver, not something you will be doing at this introductory course level, but something that will be given to you. And we've talked about how you estimate your overhead. Take that, plug in the formula, figure out the cost per hour, as in this example, and apply it per unit based on the number of hours that have been used to manufacture this product. So I hope this helps. Job order costing is our basic introduction to manufacturing, to job costing, to product costing, and it's not too difficult to understand, just lots of new concepts and ideas. At this stage, you should be ready to do the homework, ready to take the quizzes, and best of luck. If you have any questions, shoot me an email.